What we are going to learn today is the role of arbitrage in pricing options. In the first week and the second week, we did talk about arbitrage. Now we are going to use them to explain option pricing. And then we are going to learn about the minimum, maximum values of option and the value of the options at expiration, as well as the lower bound value of an option. And we're going to talk about the effect of exercise price, time to expiration, risk-free rate, and volatility on an option price. These are the main variables that affect the value of a call option or a put option. And we will see the direction in which these affect the value of the call option or the put option, as well as the magnitude. Then differences between prices of European and American options. So we talked about European options and American options. We are going to learn the pricing of European and American option in the sense that whether there are any differences, and if there are, how they affect the values. And finally, we are going to talk about put call parity. At the start, we need to clarify the symbols that we are going to use in our discussions. And throughout, mostly we will be relying on these symbols from now onward when we are pricing or valuing options. So S naught here will be the current stock price. So remember this, S naught is the current stock price. X will be used for the exercise price in an option. T, capital T, will be used to reflect time to expiration, and in our case it will be days until expiration divided by 365. So it will be expressed as a ratio. So for example, if there are 90 days to expiration, so it will be calculated as 90 divided by 365. R will be the risk-free rate, and we are going to learn next how to calculate the risk-free rate for option valuation. And then we are going to have a look at the expiration prices, the spot prices when the option expires. So that will be denoted by ST, which is the spot price at expiration. And this notation that we have here, for example, the first one is CS0 TX. We are going to read it like this: the price of a call for a given stock price expiring in a given expiry time period at a given exercise price. So this is the call price for a given time period at a given exercise price for a given underlying in the spot. So this is representing the call price, and this is representing the put price. And these three are actually denoting the current spot price in the market, the time to expiration, and X is the exercise price. Before we start any computation, the first computation we are going to learn is that of the risk-free rate that we will need to use in option valuation. And it is also important for your assessment, because in your coursework you are required to value call options and put options, and you will need to have a risk-free rate. How do we calculate a risk-free rate? That is a subjective phenomena, and it varies from the valuer and the analyst from one person to another. However, the one that we are using here is based on the T-bills discount rate. So let's suppose we have a time period T0 today, and then we have T1, which is the expiration of the option. Let's suppose today is 14th of May, and we want to purchase an option that will expire in 7 days, that is 21st May. So there are 7 days to expiration. If we want to purchase an option today, that will expire in 7 days. So the option expiration is in 7 days. Today in the spot market, if somebody wants to sell a T-bill, so the dealer is offering a T-bill discount rate of 4.45. Okay, this is the bid. And if somebody wants to buy a T-bill from the dealer is quoting an ask price of 4.37. Remember, here the bond, because the interest rates and bond prices have a negative relationship, so this means if I want to sell a bond that is maturing in 1 year, and at maturity it will give me 100 pounds or dollars, okay, because T-bills are zero coupon bonds, which means they are issued at a discount from par value. The dealer is saying that he is going to purchase it at 95.55 from me. So the dealer is buying it for 95.55 from me, and he is thus quoting me a bid discount rate of 4.45. On the other hand, if I want to buy the same bond from the dealer says you can buy it from me for a price of 95 point, and how much is this? 3763. So he is quoting me a discount rate of 4.37 basically. Any question on this? Do you understand this mechanism? So if the bid is 4.45, it means that the dealer is buying at a low price if I want to sell my bond. And the ask of 4.3 here means that if the dealer wants to sell to me and I want to buy the same bond, the dealer is quoting me a higher price. So to calculate the risk-free rate, the first thing we need to do is to calculate the average T-bill discount, and that is the bid rate plus the ask rate divided by 2. So that gives us 4.41. To calculate the price of the bond, which is based on the average of the T-bill discount, what we need to do is actually use 360 days year convention. Remember, in the money market, most of the calculations are based on 360 days year. It's not based on 365 days year. And it is not any, you can say, theoretical or conceptual thing. It is just only a practice that has been there in the market for centuries, where to make calculations easy, they have resorted to use 360 days year rather than 365 days year. So to calculate the average price of the bond, we use the average discount, T-bill discount, and use this 360 days year convention, and we know there are 7 days to expiration. So 7 divided by 360. Because of the 360 days year convention, we will not be raising it to the power 7 divided by 360, but it will be multiplied by 7 divided by 360. Now this 100 means the par value of the bond. Remember, T-bills are discounted securities, that is, they are zero coupon bonds. So you purchase them at a discount from par value, and then at maturity you get the par value. So if the average T-bill discount rate is 4.41 and there are 7 days till expiration, you will purchase this bond at a price of 99.91425. If you purchase it today on 14th of May for 99.91425, and then 7 days later on 21st May, you redeem the bond, you get 100. So how much is your return? So that is called the treasury bill yield. Remember, this is the treasury bill discount, which is based on 360 days year convention. However, whenever in finance you calculate yield, you will be mostly using 365 days year. There is one or few exception, but we will not talk about it. But whenever in finance you are asked to calculate a yield, it will be based on 365 days year. If you purchase this bond for 99.91425 on 14th of May, and on the 21st May you redeem the bond, that is, you pay back, you give back the bond, you will receive 100 pounds or $100 from the government. Now, if you want to calculate your return, it is just simple calculation of an IRR. So the future value of the bond divided by the present value of the bond raised to the power 365 divided by 7, because you want to calculate the rate annualized. Remember, this is annualized rate. So that is why 365 divided by 7. Okay. So the annual risk-free rate or the yield is 4.57%. Now, this is the rate that we need and we will be using in the option valuation. To calculate the treasury bill yield, you will assume that if you purchase the bond today for this price and in 7 days it is redeemed at 100, how much rate of return you will be earning annualized. Okay, and that is 4.57%.
I just had a question. Why in the first one is it 7/360, and then the second one is the 365/7?
Yes. So you see, there we are calculating the treasury bill price. Okay. So we are calculating how much should be the reduction in the price of the bond. When I calculated all this, this was annual based, isn't it? If the bond is purchased today and held for 1 year, okay, this is like this. Now I am saying that if the bond is purchased today and held for 7 days, now this rate is applicable, this average rate is applicable for 1 year. For example, it will be 100 minus 4.41. So if I purchase the bond today for 95.59 and I hold it with me for 1 year, my interest will be 4.41. That will be $4.41. However, I am not holding this for 1 year or 360 days. I am holding this only for 7 days. So then the discount applicable should be only for 7 days rather than 365. So that is why I need to do 7 divided by 365. So I am calculating the price here, not the yield. Okay.
So will the number before 360 and after 365 be the same?
Which number, please?
Where it says 7/360.
Yes.
And then you have 365/7. Will the 7 always be the same? Like obviously it'll change number, but will that always be the same?
Yes, that will be the same. That will be the same. Okay.
Okay,
because your holding period is still 7 days. It's just that first you are using the 7 days to calculate the price, and then you are using the 7 days to calculate the yield. So for the price calculation and the discount calculation, we are always going to use the 360 days. But for the yield calculation, we are going to use 365 days. So for example, the next option is expiring on 18th of June. Okay. So you should count the days from 14th May to 18th of June. So 18th plus 17 days of May. So that is 35 days. So it will be 35 divided by 360 and 365 divided by 35. Okay. Of course, the average bid-ask spread will also change because that will be a different maturity. The minimum value of a call will always be equal to or greater than 0. And this is true for, you call it American call or you call it European call. Both of them will hold this true. So the value of any call will always be greater than or equal to 0. A call, whether American or European, cannot have a negative value. So you cannot have a situation where you see for a given stock price, time to expiration and exercise price, you have the value of a call option less than 0. This cannot be the case. Okay. So that is the first rule. For American calls, the value will always be like this. We will write it like this. The price of an American call will be always greater than or equal to the intrinsic value. Okay, this is called the intrinsic value, the maximum of 0 or stock price minus exercise price. Okay, how would we read this? The maximum of 0 or stock price minus exercise price, because there is a contingency. Okay, because the option price cannot be negative, so we are saying that the minimum it can go is 0, or if the option is in the money, it will have the stock price greater than the exercise price. Okay, now this concept is not applicable for European call, and there is a reason for that. If we look at the value of a call, the value of a call is composed of two things, and we are going to talk about it. We are talking here about the American call. So the value of an American call for us is time value of money plus the intrinsic value. And the time value of money in itself is composed of two things. Of course, one is the value because of time, and the other is the value we call speculative value. All of this is, of course, this is also speculative time. So we can say that there is time and another thing we call proximity of the stock price and exercise price. Now let's talk about the time value of money. We're going to talk about it later as well. If you have one option that expires, let's suppose that expires in 3 months, and you have another option that expires in 6 months, keeping all other things constant like the stock price, the exercise price, which option should be carrying more value? This one or this one? The option that expires in 3 months or the option expires in 6 months? It will always be this one. Why? Because this has more time to expiration, and hence it is able to allow you the ability to speculate for a longer period or to hedge for a longer period. So in both the cases, this option is covering a longer period of time, keeping other things constant for both the options. The only difference, if it is time, we will always see that the option with the longer maturity will have higher value. And we are going to sort of, you can say, make some exceptions later on. But right now we are just saying that the option with the longer maturity will always have the higher value. The next thing that we have is the proximity of the stock price and exercise price. In conventional finance, we see that time value of money is only coming from time. But here we are saying that not only time, but there is also an important element, and that is how close is the current stock price to the exercise price. So keeping other things constant, the closer is the current stock price to the exercise price, the higher will be the time value of money. Okay, so the time value of money here is composed of time and also proximity of the stock price to exercise price. The reason for this is that when an option is at the money, for example, S0 is equal to X, when this is the situation, the winner and the loser in the option, whether the call option or the put option, is not decided. And a small price movement in any direction, the stock price going up or the stock price going down from this level, will determine the winner and loser. So the closer is this price to this price, more interest will be in such options, because the uncertainty regarding who is going to be the winner and who is going to be the loser is quite high. You can think of this as an example from a football match, and let's suppose there is Manchester United and let's suppose you take your favorite team. Let's suppose I say Manchester City. Okay, if they are playing and the current score is 1-1, okay, and let's suppose there are 5 minutes or 10 minutes or 20 minutes or 30 minutes left in the game, you will be quite interested in watching the game, isn't it? Because you see the winner is not yet decided, the game is equal, and you know, if any of the team scores the goal, that will determine who will win the game. But if the score is like this and you have 10 minutes or 5 minutes or 1 minute remaining in the game, how interesting you will be, interested you will be in watching the game. Whenever the winner is not yet decided and it is of interest to you, you will actually be paying more attention to it. The same applies here, and we see that when an option is at the money, both the buyer and seller of the put are quite interested. Everybody is interested, because from here the price will determine who will be the winner and the loser. And remember, the more time is there, for example, the option is expiring in 6 months, okay, and we have the first day of the option, so there are nearly 6 months left, and right now it is S0 and X. So again, the proximity here is important, but there is also an effect of the remaining time period. So the more time that is left to expiration, the higher are the chances that the stock price can go up or go down. So that will also affect the value of the option.
So, you know, you said about the stock price and the exercise price,
Yes.
and you said the time value of money would go up. Which way would it swing for the time value of money to go up again? Sorry.
You see, the time value of money will be maximum when S naught is equal to X. That is when an option is at the money. So for example, look at this. S naught is less than X. Okay, and let's suppose it is deep out of money, or it is deep in the money. Let's suppose the current stock price is 50 and the exercise price is 100. So you can say there are very little chances that this price can go beyond X. If it doesn't go beyond X, why would you exercise your right? So it is deep out of the money. In such options, will you have any interest of buying such options which are deep out of the money? Because you know here a clear winner would be mostly the call writer. On the other hand, here you see again the option is in a clear direction. The call buyer will be the winner in such a case because the option is already deep in the money. Let's suppose the exercise price is equal to 100 and the stock price is 600. Okay. In this case, you see that there is very little chance that the price will drop from 600 to below 100. So most likely the call buyer is going to be the winner. So here you are not talking about time to determine what will be the speculative value of the call or the time value of the call, but you're talking about the closeness of the stock price to the exercise price. Okay, so the time value of money in option pricing is not only because of time alone, but it is also because of proximity of the stock price to exercise price. And this holds for both call options and put options. For American options, we said that the concept of intrinsic value holds, but it does not hold for European. And the reason is that the American calls can be exercised anytime prior to expiration, while the European calls cannot be. And that is a huge thing for why it cannot be applicable for European call. That is the intrinsic value concept. So let's have a look at the DCRB calls here. And we have this is the exercise price and this is the intrinsic value. Okay, let me just go to the previous slide. So you see the DCRB exercise price of the calls is 120. For 120 and expiring in May, the price of the call is how much? 8.75. And the current stock price S naught is how much? 125.94. The exercise price for this maturity is how much? 120. And the call price is how much? 8.75. And I told you that the price of an American call will be equal to the intrinsic value plus time value of money. Now, if we look at the intrinsic value here, the intrinsic value will be maximum of 0 or S naught minus X. So intrinsic value here is maximum of 0. S naught is 125.94 and X is 100. So intrinsic value is how much? 5.94. Now, if I know that intrinsic value is 5.94 and I know this relationship, I can calculate the time value of money is equal to the price of an American call minus the intrinsic value. So the price of the American call is 8.75. So 8.75 minus the intrinsic value of 5.94. And if I do this, I get the answer, which is equal to, if I go down, 2.81. So the time value of money for the American option is 2.81. So you see, the call price in this case is composed of intrinsic value of 5.94 plus time value of money of 2.81. And we have proved that this is equal to 8.75. The same can be used to actually calculate the intrinsic value for this call and the time value of money, and then for the July one. And then we can do this for the other option. which is having an exercise price of 125, and that expires in May. So this call will have its intrinsic value only equal to how much? It will have its intrinsic value equal to, you see, if you look at the current stock price is 125.94, and the current exercise price is how much? 125. So its intrinsic value is equal to 0.94. I'm talking about this one. So that means that most of its value is then coming from where? The time value of money.
You know, in the, sorry, what you wrote on the top right hand side, where the maximum is the difference between the current share price, stock price, and the exercise price. Why was it 100 in that one?
Oh, sorry, this is 120. This is 120. I did it correctly. I calculated this 5594, but this is 120. Okay.
Okay, thank you.
This is exercise price. Okay. So that was just a typo.
So what's the symbol before stock price?
This one.
Yeah.
This is 0. The maximum of 0. The comma is read as R. So it is 0, comma S0 minus X. However, I will read it as maximum of 0 or the comma I will read as R. Okay.
Okay, cheers.
Yeah. Okay, so if I go here, you see, have a look here. Look, why is this option having higher time value of money than this option? Both are expiring in May. Look, this option has an exercise price of 120. Compare it against the current stock price of 125.94. And this option has an exercise price, and again compare it against the current exercise price of 125.94. So though the intrinsic value of this call is lower than the intrinsic value of the 120 call, we see that the time value of money is the maximum for the option that has the exercise price closer to the current stock price. Are we clear now?
Yeah.
Okay, that's fine. And you know, again, have a look here. The longer is the time to expiration, the higher is the time value of money. So you see the June option, you know, both all these options have the same exercise price. Exercise price 120, exercise price 120, exercise price 120. But because they are expiring in a longer period, so you see, keeping other things constant, the option that has the longer maturity has the higher time value of money. Okay. And then if you look vertically, here we are seeing that the option that has the price, the exercise price closer to the current stock price will have the higher time value of money. So both vertically we prove the proximity concept, and horizontally we prove the longitudinal or time value concept in traditional way.
What does DCRB stand for?
Let me just it's the call on the company call. Let me just confirm this. I've just forgot the name. It's the name of the company which calls we are using. DCRB.
Oh, it's the company name. That's fine.
Yeah, it's the symbol of the company basically.
No problem.
Okay. You see, let's suppose if the 120 call has an intrinsic value of 5.94, okay, and we saw its price was the price of the call was 8.75, and we are saying that at any point of time the American call in such a case will always be trading at a price higher than its intrinsic value, which is the case here. Okay, which is the case here. We have proven this. But just suppose that the call price is not this, and the call is trading at a price of $2. Now you see here the intrinsic value of this call with an exercise price of 120 is 5.94, and we are saying that the call price should always be greater than the intrinsic value or equal to the intrinsic value. That's what we are saying. But let's suppose the call price is $2. What will happen? There will be an arbitrage. What will people do? If I were you, I would buy this call for $2. Okay, I bought the call for $2, and I will, because it's an American call, I will straight away exercise it. Why? Because if I exercise it, what will happen? I will pay to the writer of the call $120. Okay, which is the exercise price, and I will receive the share worth $125.94. So I will exercise, I will buy the call, I will straight away exercise it, give 120 to the call writer and receive the share for 125.94, sell it in the market for 125.94. So my gain from the call exercise will be 5.94. If I deduct my purchase price of the call, I am making $3.94 straight away. Do you see this? It's an arbitrage, isn't it? The call is underpriced at 2. So what will happen? I will buy the call for $2 and straight away exercise it. If I want, I even don't need to exercise it. I can hold it. Okay. 120 I will pay to the call writer, and he will go deliver me the share, which I will sell in the market for 125.94, and I will make a gain of 5.94. If I deduct my purchase of the call, the cost, I will still get 3.94, which is a huge profit here. If I do this, everybody else will start doing the same, which will drive the price of the call up. And again, we will be restoring this situation. Once this is restored, then this arbitrage will eliminate. If the call price is higher than the intrinsic value, like for example, it's 8.75. So we have to still look at it, and we will see that later if it is correctly priced. So it may be the case later on that the price of the call should be 8.75, but in the market it is selling for $11. So in such a case, what will I do? I will start writing the call, because again, there is an arbitrage. But that is something we will leave for next week, or probably week 5 or 6. Is it clear? Because it is an American call, if it is selling for less than the intrinsic value, I will buy the call and I will straight away exercise it as it is an American call. I will realize 5.94 as an intrinsic value gain, deduct my cost from it, still making 3.94. To realize or to make this money, I don't even need to actually exercise it. You can read more about it from the book, and that's what I would recommend you to do. Okay, but I have given you the intuition behind it. Why can't we do this the same for the European call? Because of the exercise option. Because if the call is underpriced, I cannot exercise it straight away to realize this gain. Okay, so I'll have to wait. If the option is expiring in 3 months or 2 months or 7 days, if it's an American, if it's a European call, if I buy it for $2, I cannot exercise it. I'll have to wait for it. So I cannot actually sort of take advantage of this.
So you know how you said so you know when you wrote $11?
Yes.
What was that in reference to?
You see, a call right now, you see, we are saying the call is undervalued at $2. Okay. But we didn't talk about overvalued. And I said that we are not talking about the overvalued thing because we haven't learned the pricing formula. Okay. Because an asset or a contract can be overpriced or can be underpriced. Okay. So here we are talking about underpricing, because we are saying that the call price should always be greater than or equal to the intrinsic value. Okay. Is it clear?
Yeah, so you know how, so with the $11.
Yeah, so if you see the call price, if the correct call price should be 8.75, and if it is selling at a price higher than this in the market, so even though it's still higher than call price, the intrinsic value, it is overpriced, isn't it? It should be trading at 8.75, but it is trading at $11. So in that case, rather than buying the call, I will be selling the call, isn't it?
Yeah.
When it was undervalued, I was buying it. When it is overvalued, I'll be selling it. But I told you that we will discuss about this more when we talk about the binomial option pricing model and the Black-Scholes option pricing model in the coming week.
Okay.
Okay. Please make sure if you have questions, just ask me. Okay. Most of this discussion is going to be quite analytical, and mostly I'll be using symbols. I'll fit in numbers wherever I feel that you should know it like that. But if you're not comfortable, let me know. Now, we talked about the minimum value of a call, and we said for any call, the price of the call will always be greater than or equal to the intrinsic value. Okay, and we said that it is true for the American call, that the American call value will be greater than or equal to the maximum of 0 or S naught minus X. And we said that the price of any call will always be greater than 0. And we said that this concept is applicable to European call and American call, but this one is only limited to the American calls. And we said that we cannot do the intrinsic value calculation or abstraction for the European. We cannot say like this. Okay, for the Europeans, we cannot say this. So we will later on talk about a concept that we call the lower bound value of a European call. Okay, so though the European calls do not have intrinsic value, they have another concept that we will talk about, and that is the lower bound value, and we will see that through a portfolio. Now, the maximum value of a call will always be less than or equal to the price of the underlying asset. Let's say I have the shares of Amazon, and the current price is $3,300. If I want to buy a call option on Amazon, what will be the maximum price I am ready to pay? Theoretically speaking, I am not going to buy the call option on Amazon for a price of $3,500. Why? I want to buy Amazon for a price that I fix today. So if I fix a price of $3,500 and pay the price of $3,500 to buy the call, why not I buy straight away the underlying $3,300? So this would be stupid if I buy the call for a price greater than the underlying. This would be really stupid, because why don't you go straight away buy the underlying for a price that is lower than? So any call option, okay, any call option will have its value always less than or equal to the price of the underlying. Okay, why we say that the maximum I am ready to pay is the price of the underlying? When will this be happening? Why I'm saying is equal to, I mean, like, you know, I'm saying that it is possible that I can buy a call option which gives me the right to buy the share of Amazon for $3,300. Okay, but I'm not ready to say that this is possible. I'm saying this is not possible, but this is possible that I pay $3,300 for a call option where I can where I see that the call price is equal to $3,300, the price of the Amazon's share in the market. But I'm saying I'm not ready to pay any price greater than this. This is not possible, but this is possible. So why would this be possible? Theoretically speaking, if I have a call option where the current stock price is, let's suppose, $3,300, and the exercise price is, let's suppose, equal to 0, okay, and the time to expiration is infinity. You know, the option has no time bound. So theoretically, it is possible that in such circumstances, the price I am ready to buy the call for maybe $3,300. So let's suppose, let's take it like this. I'm saying to you that I have a call option. I can give you a call option where you can buy the share of Amazon for 0 price from me that has no expiration. I mean, like, you know, you can come to me after 1,000 years or 100 years or 25 years. There is no time bound on it. The Amazon share is currently trading in the market for $3,300. Okay, so theoretically speaking, what is the maximum price you are ready to pay for this? 3,300. If I say 3,500, you don't agree to that. Why? You say, why should I pay you 3,500? Why not go and buy it for 3,300 and keep it with myself for 100 years? Okay, so it's logical, it's mathematical, and it's logical in the sense that I can say that, look, I want you to buy this option from me for 3,500. You say that is not rational. Why? Because why should I pay you $3,500 for the call option if I can buy the underlying for 3,300, keep it with myself for infinity then? So if you want me to be actually convinced to buy the call option, you should reduce the price to the value of the underlying. Okay, is it clear? So that is a theoretical condition. Practically, it's not doable, but theoretically, this is the maximum the price of a call can go. That is, it cannot go beyond the price of the underlying. And that is one situation of this is when the time to expiration is infinity.
So last question. So in the time being infinity, does it mean which component of the equation, the time value of money or the
time value of money? Yes,
or
you're
the
right.
time value of money is zero, basically.
No, the time value of money is infinite, not zero. Quite opposite. It's quite opposite, because it is giving you protection, till the day of judgment. And given this mathematical notation, if you are not a believer, you don't believe in the day of judgment. Infinity means that thing.
So the intrinsic value,
yes,
would be zero, because the exercise price and the share price are the same.
Yes.
Okay.
The share price is $3,300. You can buy the share from me at any time in future for zero. You can, this is extreme condition. You can put an exercise price here, because when we talk about boundary conditions, we are actually talking about what is possible and what is not possible. So the conditions are mostly, extreme. We are taking extreme examples. Okay. So this is the price of the option, how far it can go, how minimum it can be. So now have a look here. For example, for a European call, we see that the call price can be anywhere here. Okay, but for the American call, we see that the price of the call cannot be below this level. Okay, so a European call can trade at a price below this intrinsic value, because the intrinsic value concept is not applicable to a European call. And we see that for American call, the price cannot be below this level. That is what our conclusion is. So it is possible for a European call to have its value less than the intrinsic value, because it doesn't have any intrinsic value. However, later on, we will see that it has a lower bound value. Okay. Similarly, for the American call, we see that its price cannot go below this level. And if we combine this now with the maximum value of the call, we can see that for the European call, the price of the call can be anywhere here, because there is no intrinsic value concept. So we see that the price possibility, as the stock price goes up, the price of the call will go up, and it can be anywhere here. Okay. On the other hand, for the American call, we see that the this is cut off here, because you see you can exercise at any time prior to expiration. So the intrinsic value concept comes, and we see that the price of the call cannot go below this level. So there are more possibilities for the call price if it is European than it is for the American, because that its price cannot go below the intrinsic value, and these possibilities are cut off. Okay, this is just only conceptually reflected here. We don't have numbers, but in the nutshell, it means that the price of a European call theoretically can be anywhere below the intrinsic value, because it doesn't have an intrinsic value. For the American calls, its price should never be below this level, because if the price is below this level, there will be arbitrage and people will exploit it. For the European, if the price is somewhere here, there cannot be an arbitrage opportunity, because the options cannot be exercised early or prior to expiration. Remember the value of a call at expiration will always be equal to the intrinsic value. Whether it is an American call or a European call, at expiration, it will have its price equal to the intrinsic value. That is maximum of 0 or ST minus X. Now, when the option is initiated at time T0, and let's suppose this is T1, when the option is initiated, as we discussed, the price of the option can be comprised of two phenomena. One is time value of money and the other is intrinsic value. Okay, because the option has time to expiration and there is uncertainty, so it has speculative value that comes from time and proximity of the stock price to exercise price, as discussed. However, as we approach here, what will happen? The time value of money will eliminate. It's just like, when the match finishes, you already know who is the winner. So the speculative value is finished. Only the intrinsic value is left. So in this case, whether it's a call option or a put option, the price at this point will always be equal to the intrinsic value, which will be equal to maximum of 0 or the stock price at expiration minus the exercise price. When the option is initiated at this time, it is possible that the call option has only time value of money and there is no intrinsic value. For example, if I go back to the table here, have a look here. This option has 0 intrinsic value and it still has time value of money, $3.6. And this option, the June expiration option, has 0 intrinsic value and it still has $11.35 in intrinsic value. And this one has 16.4. So it is possible that at any point the option is initiated at this time or any time here till this point before the option is expiring. The time value of money will be positive, the intrinsic value may be 0 or maybe greater than 0. However, it cannot be negative. So for some options, you will see that all of their value is coming from time value of money. And in some cases, as we saw in most of the cases on the table, the price of the call was a composition of the time value of money and the intrinsic value. You see, as the time decays, the time approaches maturity, what happens? There is a thing we will talk about. We call it time value decay. So when time lapses, time value of money is eroded. As we move forward into the future, what happens? Things become more certain. So the speculative value falls. Okay, and because there is lesser and lesser time for things to change, what happens? The value of the option approaches its intrinsic value. It is just like a match. Let's suppose there is a football match between two teams, A and B, and in the first 10 minutes, this team has scored, let's suppose, 3 goals and it is 0. So we see that here the intrinsic value is high. Okay, the time value of money is also high because we still have nearly 85 minutes of play left, and it is possible that team B can actually equalize it. So as time passes on, what happens? The chances of this team equalizing the score reduces, and when the last 5 minutes or 1 minute is left, it is nearly impossible. And then when the match finishes, you clearly see that team A has won the match with 3-0. This is effect of time to expiration. Now, to illustrate this, we will take 2 American calls and both of them will be on the same stock. The only difference will be that one option is expiring in time T1. Let's suppose we say 3 months. And the other is expiring in T2, let's suppose 6 months. So both options are, let's suppose, on Apple, the underlying is the Apple's share. And let's suppose the current stock price is 125.94, okay? And let's suppose the exercise price is 120. So all the other information is the same. The only thing is T1 is 3 months and T2 is 6 months. So the rule is, as we discussed, that the option with the higher value of expiration, that is the time to expiration, will always be priced at a higher price than the option with the lower. So let me call it C2 and this one C1. And we discussed the reason for this, that whenever an option has longer time to maturity, it will enable you to speculate for a longer period and cover a longer period of uncertainty. So it has both the time as well as the proximity implications affecting it. Now, if we want to understand why this is so, let's take an example again. Let's say we have T1 here, T naught here, and we have T here. Okay, this is the time where the option is initiated, and this is the time where both the options will expire. Let's make this T2 and let's make this T1. We have option 1, which will be CA S0 T1 X. Okay, and then we have CA S0 T2 and X. If you purchase both these options, for example, what will happen here? Okay, let me just say that the table here. We have this option here. So when T1 occurs, okay, when T1 happens here at this point of time, what will T1 give you? It will give you maximum of 0 or ST1 minus X. So it will be only trading at its intrinsic value. What will be C2? C2 will be having the same intrinsic value at this point of time, ST1 minus X. However, it still has this much time till expiration. Okay, so it will also have the time value of money. So in such a case, we see that this portion of the value of C2 is greater than the intrinsic value at which the C1 will be at expiration. So that is why we say that the value of C2 will always be equal to or greater than C1 when C2 has more time to expiration. When C1 expires, C2 will still be providing you protection, or you can say the ability to speculate over the time period. We understand that C2 will be greater than C1. Why we are saying that C2 can also be equal to C1? You know, when an option is deep in the money or deep out of the money, as we discussed, we will clearly have a winner. When an option is deep in the money and deep out of the money, in both the cases, the time value of money will be 0. People will have no interest in such an option where the winner is clearly visible. So if an option is deep in the money, we know the buyer of the call has value. For example, if ST1 here is equal to 500 and X is equal to 100, so we know that ST is quite high than X, and in such a case there is very little chance of the stock price dropping over the next 1 month or 3 months to below a level of 100. So there will be no interest by the investors in such options or the speculators where we see that the call is deep in the money. So what will happen? Such an option will trade only at the intrinsic value, okay, and it will have 0 time value of money. So the call price in such a case will be coming totally from the intrinsic value. If ST1 at expiration is $10, this expiration T1, and exercise price is 100, And we see here that the option is deep out of the money. There is very little, if any, chance that the stock price will increase till time 2 to a price level above 100. In such a case, again, there will be zero time value of money. There will be no interest. Of course, there is still time to expiration, but there is no chance. It's just like, you are given 10 minutes to reach London. So there is time, but you know that you cannot reach London in 10 minutes. So in such a case, the time value of money will be of no use. It is deep out of the money. So the option in such a case will have its intrinsic value is already zero, okay, and its time value of money will also be zero. So such an option will have a value of zero. So we see that this intrinsic value, if the time value of money is zero, if this is zero, then this and this will be the same, okay. If the time value of money and the intrinsic value is zero, so then this will be zero and this will also be zero. So this is possible that C2 is equal to C1 when the option is deep in the money or when the option is deep out of the money. Any question on this?
Yeah, sir. On the next slide, would you be
Yes.
all right to just write the bits on the white because I can't see them over the writing? Is that all right?
Yeah, sure, no problem. I can do that. I'll insert slides, okay? Remember, as I told you, the time value of money is always maximized when the option is at the money, okay? So we have this concept. And remember, we talked about the time value being the function of time and proximity, okay? So it's not just like the time value you have learned in the NPV IRR thing. It's a bit different in option theory. And the concept of time value decay is very important. As I told you, when the option approaches its expiration, what will happen? The time value of money will start decreasing and the price of the call will be approaching intrinsic value. Okay, so this is what you can see here. At this point, when you initiated the option, you see the time value of money is high, and as a result of that, we see the call price is far away from the intrinsic value. But as we are approaching the time to expiration, what is happening? The time value of money is decaying, and keeping the intrinsic value constant, we see that the intrinsic value and the call price are aligning and coming closer. And this is because the time value of money is going down. We cannot do this, whatever we have talked here about, we cannot establish it for European calls yet. That doesn't mean we cannot establish it, but we haven't learned about the minimum value of the European call. So when we learn about the minimum value of a European call, we know the minimum value of an American call is the intrinsic value, which is maximum of 0 or S0 minus X. But we don't know the minimum value of a European call, which will be the lower bound value. So we will be talking about it later once we talk about lower bound value of the European call. Next, again, we're talking about the effect of the option exercise price on the option value. So we saw when there were two options, one was expiring at T1 and the other was expiring at T2. We said that the option with the longer maturity will always have a value greater than the option with the shorter maturity, or at least their value will be the same. And our conclusion was that an American call will never have its value less than another American call that is shorter in maturity than it. It can have a value equal to, but cannot have a value less than an American call option with a shorter maturity. Now, we want to keep time constant, but we want to see if there are two options keeping other things constant, one with the exercise price X1 and the other with the exercise price X2. And we want to see if C1 and C2 in such case will be the same price or higher or lower. Okay, so that is going to what we are going to talk about. Okay, now for the time to expiration, we assumed that both the options are American. For the exercise effect, we are assuming that both the options are European. Okay, and we have a logic of doing so. Later on you will see why we have it and why don't we have the other? So let's say we create a portfolio. Now, this is the first time you're going to learn option pricing using a portfolio concept. And we will see there are important lessons to be learned. So here we have portfolio A and we have portfolio B. In portfolio A, we have a long position in the call that has an exercise price of X1, and we have a short position in a call option that has an exercise price of X2. So these options are on the same, the call options are on the same stock. Let's suppose they are on DCRB call, DCRB shares. The only thing is one will give you the right to buy the share, for example, for $120, and the other is giving you the right to buy the share for, let's make it $130. So this is your C1 and this is your C2. And let's suppose both the options are expiring in 1 year time. Portfolio B, on the other hand, is a risk-free portfolio where you have invested difference between the two exercise price in risk-free bonds. Okay, so this will be, let me just take this away, and let's say we have right now P0, we have the portfolio A where we have C1, okay, which is a European call, where I have the same exercise price, the same time to expiration, and the exercise price is X1, and I have a long position, so I have a plus sign here, and then I have written a call C2, which has S0 T the same, but the exercise price is X2. So let me write here that let's suppose the current stock price is 100, okay, the time to expiration is 1 year, and X1 is 120, okay, and X2 is 130. Portfolio B, and let's take the risk-free rate. We know how to calculate the risk-free rate. So let's say the risk-free rate is 5%. So I have invested how much? Let's suppose X2 minus X1 into 1 plus R raised to the power minus T amount in the risk-free bond. Effectively, what I'm saying, I have invested 130 minus 120 into 1 plus 5% raised to the power minus 1. That is, if I calculate this, how much is this? So it should be equal to 1.05 raised to the power multiplied into 10. Effectively 9.52. So this is the bond I have purchased. It's a risk-free zero coupon bond. So if I purchase this bond today, at maturity 1 year later, I will get $10, which is the difference between X2 and X1. And you know X2 and X1 are the exercise prices in the call option here. I don't know at this point of time whether C1 is greater than C2 or less than C2. I don't know which one is higher and which one is lower. Okay, I don't know anything about it. I want to learn. I want to sort of come up with a conclusion regarding whether C1's price needs to be greater than C2 or otherwise. So I have two portfolios. Portfolio A, I have a long position in C1 and I have a short position in C2. In portfolio B, I have an amount of 9.52 invested in risk-free bonds, and this amount is equal to the difference between the exercise price multiplied into 1 plus the risk-free rate raised to the power minus T. There are two possibilities in future. Okay, let's make it read this. So in future, at expiration, there are two possibilities or three possibilities. What is possible is that ST, which is the spot price at expiration, is less than X1, which is less than X2. This is also possible that ST is greater than x1 but is less than x2. We're just going, we need to reduce the size of the font because otherwise I'll not have enough space. So I'll just clear this. So let's say we have the first possibility is that x1 is less than x2, which is less than st. Okay, this is the first possibility. The second possibility is that x1 is less than st, okay, and which is less than x2. And the third possibility is that st is less than x1 and it is less than x2. And let's say the current stock price was 100. Okay, so let's suppose in this case st is 140. In this case st is because we are saying x less than x2 and greater than x1, so that means that it should be somewhere between 120 and 130. So let's say s2 is equal to 125. st is 125, and let's suppose in this case we say that st is let's suppose 110. If st is 140, then I have the right to buy this share which is selling in the market for 140 for a price of x1, which is 120. So I will exercise my right, and if I exercise my right, I will receive the share which is worth st, okay, and st is, remember, 140. And I will exercise my right at expiration, that is 1 year later. I will have to pay the exercise price x1, which is equal to 120. Okay, so if you see, look at this, this is like, you know, I'm gaining $20 in this case. However, on the other hand, I have written a call where I have the responsibility or the obligation to sell st for x2. So if I look at that situation, I have the obligation to sell. So what will happen? I will sell st, the share that I was purchasing in the first call. I have to now honor my call because I have a liability here. So the writer of that call will also have his call in the money and he will exercise. So I will deliver st, which is worth 140, and because I will be paying it, so it will have a minus sign. And I will receive x1 because that is the price I have agreed with the call buyer that I will receive, and I will pay him the share. So I will receive x2, which is worth 130. So you see, in this case, both the options are in the money. The option that I have purchased and the option that I have written. This is the payoff from portfolio A. This will cross with this and I am left with x2, which is 130 minus x1, which is 120. So you can see my payoff is effectively $10. If I look at portfolio B, what is happening in portfolio B is that it will mature to its par value 1 year later. So I will get x2 minus x1, and x2 minus x1 is the same $10. So this is the payoff from portfolio A. This is the payoff from portfolio B if the stock price at expiration is greater than both x1 and x2. So this was the first situation. The second situation is if st is 125, in that case, the first call will be in the money, but the second call is out of the money. So I will exercise my right and I will receive the share which is worth $125, and I will pay x1, which is $120. However, the call that I have written, this will be out of the money. Why would the buyer of that call ask me to give him the share for 125, that is the share that is currently worth 125, which can be purchased in the market for 125, and he pay me 130 for it. So he will expire his right. In that case, the portfolio B will give me a payoff of st 125 minus X1, which is 120, and this is equal to $5. This is a risk-free investment, so no matter where the stock price goes, I always get X2 minus X1, which is equal to $10. So you can see that in this case, the payoff of this portfolio is equal to the payoff of this portfolio. In this case, we see the payoff of this portfolio A is less than the portfolio B payoff. In the third situation, we see the stock price is 110. So I will not exercise my right. Why should I buy something for 120 if I can buy it in the market for 110? So I will not exercise my right. The counterparty will also not exercise their right. The result is that this portfolio will have zero payoff. And this portfolio is a risk-free portfolio, so it will always have X2 minus X1 equal to 10. Is it clear? Now, if you look in the three situations, which portfolio is the dominating? Out of the three situations, 1, 2, and 3, portfolio B is dominating here, portfolio B is dominating here, and portfolio A is what? Equal to portfolio B here. So in no case, portfolio A is better than portfolio B. However, portfolio B is better than portfolio A in situation number 2 and situation number 3. We can see that in this case, X2 minus X1 into 1 plus R raised to the power minus T should always have a higher value or an equal value to C1 S0 TX1 minus C2 S0 TX2. So our conclusion from this is that portfolio B will always have a higher value or equal value to the difference between the price of this call and the price of the second call. Okay, have a look at this. Is there any chance of losing money in portfolio A? We know portfolio B is a risky portfolio, a risk-free portfolio, isn't it? It is a risk-free portfolio. No matter what happens, portfolio B always pays you $10. So this is a risk-free portfolio. Okay, so there is no worry about it. However, portfolio A has a call option C1 and another call option C2. And we see in no case it can lose money. Is it losing money here? No. Is it losing money here? No. Is it losing money here? No. By losing money, I mean the payoff is never negative. Always the payoff is positive or zero. If let's suppose, if this is the case, let's suppose if you remember when we started, I told you that we don't know whether the price of C1 will be greater than or equal to or less than C2. Okay, so we don't know. Our objective is to prove whether the price of C1 will be greater than C2. And these options are the same. The only difference is one has an exercise price of X1 and the other has an exercise price of X2. So we want to know which option, call option, has the higher value. So let's suppose if this is the case, that the price of C1 is $5 and the price of C2 is $8.
And he's talking as well.
Okay. Can this be the case? Can this be the case? Can you please turn off your mic, please? Okay, can this be the case that the price of C1 is $5 and the price of C2 is $8? This would mean that to buy C1, I pay $5 and then I will sell C2 for $8. So if this happens, I will be able to receive a $10 net cash flow or $3 net cash flow. If this happens, then there is arbitrage. Why is there arbitrage? You see, if the price of C1 is less than C2, what will happen? That I will be selling the second option for $8 and I will receive the $8 and pay $5 to buy C1. $3 will be left, which I will pocket in my with myself, and I don't need to worry about the future liability, because there is no chance that in future, whether the stock price goes down or goes up, I may lose money. Okay, so there is no chance. So if this is the case, this 3 is arbitrage because the portfolio will take care of itself. And in this case, for example, will give me $10 more return. And in this case will give me $5 more return. So my gain here will be 10 plus 3, 13, and 5 plus 3, 8. And in this case, my gain will be 3. So in no case I am losing money. I will win money upfront here when I initiate the portfolio. Then I will win money if the stock price goes up. Then I will win money if the stock price still goes up but is still less than X2. And even in this case, I don't have any chance of losing money. So this cannot be the case, because if C2 is greater than C1, okay, what will happen? Arbitrage. I will pocket money upfront, and there is no chance of I losing money. So in derivatives, whenever you have such a situation where there is no chance of losing money in the future payoffs, you must have negative cash flows upfront. Okay, you must have negative cash flows upfront. If this is not the case, then there is pure arbitrage. So what is possible? It is possible that the price of C2 is greater than C1 is greater than C2, but not C2 greater than C1. So what will happen? I will buy, for example, this for $9 and I will sell this for $5. So you see, I have to invest $4 here upfront. Previously, if I was selling this for $8 and I was buying this for $5, I was pocketing $3 upfront, and there was no chance of me losing money. So I was making an arbitrage profit. Now, what is happening in that case, that I have an upfront positive cash flow and no chance of a negative cash flow in future. If I am confronted with this sort of payoff, I will always have this as a possibility, but not this as a possibility. So in this case, if I buy the C1 for 9 and C2 is sold for 5, I will have to invest $4 out of pocket. And in this case, if the gain is 10, my net gain will be 10 minus 4, 6. And in this case, my net gain will be 5 minus 4, 1. And in this case, I have a chance of losing my $4, so I can actually suffer a loss here. So this will actually avoid arbitrage. Otherwise, if C2 is priced at a higher value than C1, there is an arbitrage. So now we have concluded that this is not possible, because this will be arbitrage in such a situation where you have no negative payoff in the future. However, C1 can be greater than or equal to C2. This is possible. This is the way forward.
You know, on portfolio B, can you just explain a bit about the 1 plus the risk-free rate?
Yes.
To the power
so you see, I'll explain that. You know, if you look at, let me just clear this now. Any question on this other than the risk-free bond? Let me just come to the valuation of a zero coupon bond first. So, you know, a zero coupon bond is issued at face value. Let's suppose the face value is 100. Okay. And let's suppose the time to expiration is 3 years. And let's suppose the rate of return that you want to earn is 5%. So what is the price of this bond? It will pay no interest in the first 3 years, but you will buy it at a discounted price from par value. Okay. And you will hold it with you for 3 years, and after 3 years you will get the par value of the bond. So the price of this bond will be equal to the par value of the bond, which is the future value or the face value of the bond, divided by 1 plus r raised to the power t. And you can also write it like this: face value of the bond multiplied into 1 plus r raised to the power minus t, because when you bring this up, it becomes minus. Okay, so this is the formula. And if I value this, it will be 100 into 1 plus 5% raised to the power minus 3. And if I do the calculation, I'll get the price of the bond, which will be 1.05 raised to the power 3 minus multiplied into 100. That is equal to $86.38. So if I purchase this bond today for this price, and I keep it with myself for 3 years, in 3 years time I will receive no interest, and after 3 years what will happen, the bond will be redeemed at 100 par value. So I invested $86.38, and I got back $100 after 3 years. So my rate of return, you remember the yield we calculated, so my yield will be, which will be equal to the IRR of this bond, will be equal to the price I received after 3 years divided by the price I paid to purchase this bond. Let me just say the price I purchased, the price I received for this bond after 3 years plus the price I purchased the bond 3 years ago, 86.38 raised to the power, it will be 1 over 3, I guess, okay, minus 1, and this will be the yield in this case. Okay, it is annualized. If I do this, it will be 100, it will be exactly, I think, the 5% I get. 100 divided by 86.38 raised to the power 0.33 minus 1. So it is 5%. We did the same in our calculation. Now here in the calculations I was talking about, what is happening is I am saying that the face value of the bond is equal to the difference between the exercise price of the X2 and X1. Okay, so that is the face value. So if I want to calculate the future, the present value of this, like I did for the face value calculation, that is face value is equal to 1 plus R raised to the power minus T, I will do the same for X2 minus X1 raised into 1 plus R raised to the power minus T. So you see, it's the same calculation. The only thing here is that the face value of the bond is not equal to 100, but the difference between exercise prices.